What exactly are total return swaps? Can you give us a little background?
So what are total return swaps? Um, these are really an agreement between two counterparties where a counterparty would transfer an asset, whether it's a stock or a bond, to another counterparty, still receive any capital gains or any interest or dividend payments, but no longer own the asset. In exchange for transferring the asset, they would receive cash back or leverage, and they would pay an interest on that cash versus a reference rate, usually LIBOR, and they would still be responsible to pay any capital losses on that position. So it's really a way of moving an asset from your balance sheet onto the balance sheet of another counterparty, retaining the same economic interests as though you own the asset, but receiving leverage on it.
So there is no need for prime broker custodians in TRS.
The custodian would generally hold the stock in custody, and it would be your stock as an investor. Whereas when you would do a total return swap, the stock or the asset would be transferred to the other counterparty and it becomes their stock. So essentially it's a kind of synthetic prime brokerage, and many prime brokers do offer this synthetic service. It's just generally offered on perhaps more esoteric or tax efficient markets than globally across the board. So we find with our client base, one of the advantages is, the cost. As a cost of financing, we can be more aggressive in pricing a total return swap to our clients than perhaps they would get from a traditional prime brokerage account. So it can be commercially more attractive to them. Disadvantages, you don't own the stock, so although you still own the economic interests in the stock, it's on your counterparty's balance sheet. So you would have an over-the-counter risk to that counterparty. So as well as having the market risk on the stock as though you would if you owned it, you also have a counterparty risk. So it's pretty important that you choose a counterparty with a strong enough credit rating to support that investment.
So hedge funds like TRS, but who else makes use of them?
So hedge funds have traditionally been a very big user of total return swaps because it allows them to transfer their asset to a counterparty, usually a bank, who's got much better access to funds at a lower rate, so it can be more economic than they could do it themselves. Swaps have been fairly successful in markets like the UK with sophisticated retail investors who would be accredited professionals taking positions because of the saving over the local stamp duty taxes. But many pension funds are restricted because a swap would be classed as a derivative instrument, and many pension funds wouldn't be allowed to invest in a derivative instrument.
What exactly has been the demand for TRS among your clients?
We found the demand from our clients has grown. Our clients are all professional investors, so they're either pension funds or hedge funds, and many of the hedge funds have been users of TRS for many years. We found that as we grow into more markets, we get demand to offer swap products on those more esoteric markets. For example, we're about to launch a swap product on Saudi Arabia later this year. So the demand's grown as our market coverage has grown. Also as well, investors have used swaps as a financing tool for emerging markets, but increasingly, because of the cost savings they can get in their funding, they're now starting to look at it more for developed markets they otherwise wouldn't consider. So we're doing a lot of swap product on US markets that traditionally would always be done as a prime brokerage account.